Hello again, fellow BeachBum traders. Thank you for joining us for part one of our weekly trading game plan for Halloween week, the week of October 31st through November 4th. And our theme for this week is Beware of Zombie Stocks. We'll talk a lot about zombie stocks, zombie ETFs, how to avoid them, how to identify them, how to beware of them, and we'll provide you with a lot of references to additional information about zombie stocks. Again, sticking with the Halloween theme seems to be popular. I see other people are catching on to the theme of zombie stocks and zombies. So again, we'll talk about strategies of how to beware of zombie stocks, how you don't get caught by the zombies, trapped in the zombies. And again, stick around to the end of the video. We'll talk about our strategies, etc. for that. We'll also do our standard market analysis, look at all the how the markets ended last week, and we'll talk about the economic data that came out last week and the economic data that's coming out and earnings coming out this week. And then again, we'll plan our strategies for how we're going to pick our individual stocks, ETFs, etc., to put on our watch list, which we'll do tomorrow in part two of our weekly trading game plan. Same time, same bat channel, 10 a.m. Eastern for part two, where we'll update our watch list with our individual stocks and ETFs for our watch list. And welcome Walter Lyons, Flip of the Shippa, Arthur Duncan. If I missed anybody, thank you for joining us for our live stream, our live chat for our live stream today. So we'll get started. So here's our notes for our weekly trading game plan. They're in a Google document that's accessible. You should have the link to this Google document in the description box below. And there's also a link to the public folder in our Google Drive that contains the Google documents for the notes for our weekly trading game plan, so you can refer back to these. They have links to the tools, other references, etc., that we use as part of our weekly trading game plans. And again, that's all publicly accessible, and you can find the links to this Google document in that Google Drive in the description box below. So just a high level before we dive into the market analysis, etc., is again our theme for this week is beware of zombie stocks. So this week, so that I didn't have to go into a lot of detail in this video about what is a zombie stock, what's a zombie company, what's a zombie ETF. I produced a couple videos that explain those in more detail, what are zombie companies, etc., what are zombie ETFs, and as a bonus for watching this game plan today, you can find links to those videos in this Google document and also in the description box below. Again, they're currently unlisted. They were released previously to our Patreon members, and now, again, as a bonus for watching our part one of our weekly trading game plan, you can watch those. Again, those will define what is a zombie company, what is a zombie stock, what's a zombie ETF, and give you a lot more references about those. But again, we'll talk in more detail in our strategy section. So I'll bring up FinViz. I see there's a lot of discussion in the chat. Let me scroll back a second. You may have to remind me when we get to the Q&A at the end. I see something about Form 4 SEC filings. Thank you, Walter. Walter, it looks like Walter's helping answer those questions. So please remind me again when we get to the Q&A section at the end if our other BeachBum traders haven't answered your questions. Arthur and I will try to address them then. So again, please remind me. So I'm on the homepage for FinViz. We can see how the markets ended up for the week. We see on Friday there was a big rally. We'll talk about why the big rally on Friday after what happened with the earnings, with all the mega caps, etc. We see Amazon was big red. Pretty much all the mega caps, even Apple, pretty much Apple buoyed up the markets, even though they announced poor guidance. So it was, kind of a technical rally, relief rally, and again, we'll talk about it in more detail. But we saw a lot more advancers, 70%, about 50% new highs versus lows. We see now almost 50% of all the stocks are above their 50-week or 50-day moving average, but only 26% are above their 200-day, showing, Friday was very bearish. Surprisingly, again, after the poor earnings that came out. So as you can see, sometimes oftentimes the market is not rational based on the data that came out before, and we have to adapt and go with what the market gives us. So we look at a little bit of the news. So stellar October for the Dow, my big tech ugly rout. A lot of, the British Prime Minister turnover. Elon's got Twitter, it's now private. So tech catastrophe week. Again, all the tech earnings were generally bad, including all the mega cap techs, the FANG names. So we see oil ran up, again, a little counterintuitive given some of the data that we have, and the strong dollar. Natural gas did come back down and then bounced back up a bit. Gold was up and then came back down, partly due to the strong dollar. We see futures on the indices is currently positive. See the euro had it broke parity again for a little bit and then declined. The yen has been all over the place. It was much higher previously. The British pound recovered, and we see the treasuries had dropped near 4% and then bounced back a little bit. We'll talk again. The big news for next week, obviously, is the Fed interest rate decision, and we'll talk about when that is and kind of our opinion as to expectations for that. So let's look at each of the indices in more detail. So we'll look at the SPY, which is the S&P 500. We see, it had a nice bounce starting on the 13th, chopped up. It's now broken its 50-day moving average. It's possibly acting as support now. Well, that's the 200 days, so it actually broke that. I'll zoom out a little bit. So there's the 50-week moving average, so it's testing that. You see we got a little bit of a gap up. Again, none of this is financial advice. We're not financial advisors. This is for educational and entertainment, hopefully purposes only. But I'll give you my opinions or possible outcomes. And again, our philosophy is to plan and be ready to adapt and act based on possible outcomes. I'm not big on predicting what's going to happen. It's more, what am I going to do if one of these possible outcomes happens? My point being is it would not surprise me to see a rejection given that gap up, see a rejection off that moving average for the SPY. We'll see if the others look similar, but I wouldn't be surprised at a retracement early next week after a run up like that. So we'll look at the Qs, the NASDAQ. Similar, not quite as much of a gap up. Again, a lot of the tech firms had poor earnings. It's a little surprising even that the NASDAQ is up, but it is running up. It may be a bottom. We'll have to see. Hasn't really made a higher high yet on a longer term, and it is below its moving average. So it does have a little bit of room to run before it possibly meets that moving average. So we'll see. Dow had a good week, as we saw in the news. We see that big gap up, jumped up above its moving average. Now it's going to test its 200-day moving average. Again, performing very well. I wouldn't be surprised if it did touch the 200-day moving average for the Dow and possibly get, it's going to run into resistance there and possibly get rejected. And then we'll see if it can build up steam to break out and go to test the previous high. So we'll see. Russell IWM and broke through its 50-day moving average. So, big push on the past week. It's got some room to its 200-day. I would expect, possibly something similar. It may continue to run up until it hits that resistance on the 200-day. Look at the VIX. Surprisingly, even when the markets were declining, the VIX was declining. So it's been pretty much declining. It's now 26.15. Let me see what it currently is. 25.75. So it's been retracing, reverting to its mean. I would expect it to continue down into the Fed interest rate decision. Now, again, we'll talk a lot more about the interest rate decision coming up and my opinions as to outcome and potential outcomes. But I would expect the VIX to continue to retrace until we get to that Fed decision. So if you want to, play it accordingly, we can talk about trading volatility. We'll probably talk about that more tomorrow. So also wanted to quickly look at VTI. VTI is this total market ETF. It covers like 4,000 stocks, and I've been using this more and more as a way to smooth out the various indices and look at the market as a total, as a whole. Again, it covers like 4,000 stocks, so it's not just one of the indices. So we can see on that total market, it broke its 50-day moving average, bounced up, it's headed up, trending up. We look at weekly, it's sitting right at that 50-week moving average. So we'll see if we get some resistance there. Again, that looks at total markets like 4,000 stocks. So it's a pretty broad index. It's all U.S. stocks. So Walter says, yeah, the SVXY is the short on the VIX. And again, get my opinion, it should be good until we get close to the Fed decision. I would be careful with it. We'll talk about, again, possible outcomes with the Fed decision. So we'll look at groups, sectors, industries, and FinBiz briefly. So if I go to the groups tab, again, we see almost everything was green on Friday. Technology had a big run. We see real estate's been recovering. The underperformers on Friday were, the top performers on a longer term, which is energy basic materials. So we've been talking about this for quite a while, is the sector rotation, where, in my humble opinion, they're profit taking in a sector that has run up, and they're flowing money into the underperforming sector until it's outperforming, and then rinse and repeat. So we've seen this, the bottom performers get run up, and then the top performers we see profit taking. And again, this rotation is just continuing, rinse and repeat. So for the week, we saw real estate was one of the top performers, and it was on the bottom previously. If we look at the month and the longer term, we see real estate's at the bottom. So again, they're taking, and for the month, it was one of the lower performers. And again, they're moving it up the chain. So energy was a top performer for the month, and on Friday, they ran that down, and for the week, it was kind of in the middle. So it was, one of the lower performers. So again, this rotation, this is a good way to see possible opportunities, as whoever's there, except for maybe communication services and technology. But you see, even when they underperform, they turn around and start running those sectors. So again, if you're looking for shorter term trades, day trades, momentum, scalps, etc., looking at who's underperforming and wait for that momentum to build up where they start running it, I think there's opportunities there for you. So I hope that helps. So we'll look at the industries. Again, on Friday, it was a lot of the underperformed semiconductors. They ran semiconductors. And again, this is just an underperformance. It's been pretty negative. So they ran semiconductors. Pretty much all the tech was running, even biotech. Again, all underperformers on Friday. They were running up. And then things that had been positive, copper, some of the gold, oil, etc. on Friday, I think that's just profit taking because several of the oil companies had very positive earnings and they were down. Um, Solar's another one that they've been running up and down. It was underperforming, then it'll run up and then it'll run down. So tomorrow I've got a couple solar stocks that I'll point out that I think when they do this sector rotation, there's a couple that might be worth trying to play when they run solar. And again, it's just occasional. You'll see it start to run and it'll go for a day or so and then it'll drop down to the bottom. So again, for the week, again, we see materials. Now, aluminum's still kind of down, and we've been talking about aluminum for a while. We've been watching some aluminum opportunities and talking about potential catalysts in that area. So it is still down, so that may be an opportunity there. So Flippa says my bios are heating up. Yeah, you see they tried to, pretty much they took out all the underperformers and tried to run them, particularly on Friday. So just, again, if you're momentum trading, day trading, scalping, you go with it, run the momentum, make your money. Just be careful because the fundamentals underneath that, particularly if we get a surprise with interest rates or interest rate decision is as I expected, that the air may come out of those pretty quickly. So just be careful, protect your profits, take your profits, sell the rip. Just remember, we don't have a strong indication yet that we're out of a bear market. We may have seen a bottom. We don't know yet until we get a new higher high or we break above the 200-day moving average. It's hard to confirm that we're out of a bear market yet. So just again, be careful. We don't want to see anybody get hurt out there. That's why we're here, right? So I'll bring up the economic calendar in investing.com and I'll go over just some of the highlights real quickly and then we'll talk about what's coming up next week. And Flip is talking about biotech. I'm going to talk about some biotechs when we get to zombies as well. So. And we can also talk tomorrow about other ways besides XBI and I'll even forget the other index for biotechs offhand, but LabU and LabD are leveraged ETFs to play biotech. So we can look at those tomorrow too. So there wasn't a whole lot Monday, Tuesday, Wednesday. We see mortgage rates keep running up. We keep hearing, the housing market is in recession. It's in decline. All the data is supporting that. Again, the whole mortgage markets is bad. It's in a recession. Trade balance down. Retail inventories are down. Wholesale's up a bit. New home sales decline, not as much as people thought or expected. And they got more sales. This was, like I was saying, was a bit surprising with the oil futures is, we had a inventory increased in oil and yet the price went up. So again, counterintuitive. You would think on supply increase, the price would go down. It did not. We didn't really have any other OPEC news or anything. I think it was just oil's been bouncing between 80 and 90, and I think it got low, and so they ran it back up to near 90. It looks like it bounced down again from 90. So gasoline inventories are also down. Then Thursday, we got jobless claims. So this is important, PCE, et cetera, and GDP data. So this is all important inputs to the Fed rate decision. And here's my opinions on several of these areas. We see continuing claims is up, so more people are still unemployed. Um, we see initial claims was below expectations, but still up, but not significant. And we see continuing for the week is kind of steady. So the jobs data, in my humble opinion, continues to show that the job market is strong. It's resilient. We're not seeing a big spike in unemployment, and that's going to make the Fed more hawkish, right? More aggressive. They can raise without fear of unemployment spiking. So then we saw core PCE prices. So inflation's not really coming down much. So again, inflation's still high. It's not really coming down. And again, that's going to cause the Fed to be more aggressive, more hawkish, raise interest rates higher to try to kill inflation, which is their number one priority right now is kill inflation. They got to get inflation down. And we got GDP data and it was positive. Now, um, this is the first read on quarter 3 after 2 quarters of negative, which would indicate we were in a recession. We got a quarter, at least the first read on a quarter that was positive. So this says the economy is also being relatively resilient. We're not diving into a recession right now. Now, does that mean we're not in a recession or we're not going to go in a recession? Again, my humble opinion is I think we're in a recession. I think we're in the initial stages of one, and I don't think we're going to see the full brunt of it till early next year. Again, all my opinions. This is for education purposes only, but that's kind of how we're positioning and strategizing. So then also, we saw natural gas storage was positive. It was less than expected, but again, still positive. So there's still an increased storage in natural gas. And so, again, the price one would expect the price to come down. Initially, they ran it up. I know Walter and some other people are familiar to do trading in natural gas, and it was very counterintuitive when that number came out. They initially ran the price up, and then a day or so later it came back down. So again, that's how natural gas is, and you have to just kind of play the price action and make your money with whichever way they're running the price at the time. So then Friday we got PCE was a little below expectations, but still high. So inflation's still high. And that may be part of the cause for the big rally on Friday. Again, it's all still high. Personal income is positive, so spending's positive. So all those are saying, the economy is still resilient. The consumer is still relatively resilient. We got consumer sentiment was generally pretty good. Expectations in line. Consumer sentiment went up just a little bit above expectations. Again, it's coming off of a bottom and improving. So again, the consumers, is healthy. At this point, there's no panic from a consumer standpoint. But they're still expecting, 5% inflation. So well above the 2%. So I think hopefully I covered all the major economic data from last week. If I missed anything, we can whip through it real quickly in a second. Next week, obviously, we'll look at the calendar in more detail on investing.com, but the big economic event for next week is on Wednesday when the FOMC, the Fed, comes out, makes their interest rate decision. That decision, the statement will come out at 2 o'clock. Then Powell will come out at 2:30 and do his press conference. Again, expect, potential for a lot of volatility. I personally expect a lot of people to be sitting on the sidelines in preparation for the Fed decision. There might be, some attempted runs in various areas, but I think a lot of people are going to wait and see what that decision is. Now, I'll give you just my opinion right now as to what I think and what the potential risks are in that area. Is I've expected a 75 basis point interest rate hike for November for quite some time. I still expect that. people, the Bank of Canada recently came out and they only did a 50 basis point hike last week. And I believe that also stimulated the rally in our markets because people started to think maybe the Fed would only raise rates 50 basis points this time. My humble opinion, again, I think that's delusional. And I think we're going to get to 75 that they pretty much, broadcast. They made it pretty clear. November is probably going to be 75. The question, the one that's more in question, would be December. I personally, again, I expect, unless something dramatically changes, I expect another 75 in December. Several Fed officials are still talking that the rates need to get. Now they're talking 5%. So that's again kind of my expectations, but the market I think started to move based on an assumption that we might get a 50 basis point, and I think there's a potential for a negative shock if it comes out to 75, which really is what everyone should expect. So again, watch out for a negative reaction. If it comes out just to be as expected at 75 basis points. So um, again, tomorrow we'll talk in more detail about the specifics of how I'm playing the volatility and positioning for that interest rate decision. So again, this week I think we covered, we had some manufacturing was kind of negative, services was negative. We covered that mostly. So I think we covered the major ones from last week. So again, coming up this week, got a little bit on PMI, nothing major on Monday. Got OPEC. We'll see if they do any further cuts to oil production or just kind of hold the line. Got some other manufacturing data, jolts. Now this will tell us again more data about open job openings. The expectation is for open jobs to decline. I would expect that people are closing open jobs first before they're laying off, and before they're doing deeper layoffs. Um, Mortgage typical ADP. So here's some payroll data, again, jobs data, typical oil, and then the Fed decision on Wednesday. And that's really going to dominate the week. Earnings is also going to be important, significant earnings. So you'll get the daily volatility based on earnings, but a lot of the week is going to be based around the Fed decision on Wednesday. Then we get jobless claim data after the Fed decision. So this isn't going to go into the November decision anyway, but it might bode for December. So we get more manufacturing data. Again, all this will go into looking at forward to December. So also there's, we're right in the middle of the earnings calendar, and you saw, how much earnings is impacting some of the stocks. Not always intuitive, sometimes counterintuitive. We saw the mega cap bangs were bad, and initially they dropped, some 20%, etc. And then on Friday they bounced back. And again, just my humble opinion. But I think there has been, and there still probably is, a ton of cash sitting on the sidelines, and people are just waiting to, buy the dip on some of these FANG names, etc. Anything that they're comfortable with. So again, your Apples, you saw how strong Apple bounced on Friday, even though their guidance was generally poor. So again, earnings matter. So take a look through the earnings calendar. You can see who's reporting. This is the lengthy calendar on investing.com. I'll show you the near-term calendar in Webull as well. But if there's anything you own or it's in a sector of something you're looking to buy, you're going to want to pay attention to their earnings. A lot of them are coming out negative. There are very few that are beating their earnings. Also, you notice the strong dollar is causing foreign exchange headwinds on all your international global companies. And that's something we talked about, weeks ago, in how to play the strong dollar. is be aware of how dollar strength is impacting earnings and the companies you're looking at. So Tuesday, there's some heavy biotechs, pharmas, etc. So again, that could significantly impact biotech, some oils on Tuesday, etc. So again, I'll let you look at those in detail. Just it's important to be aware of, and then pay attention to number one, what do they report? Number two, how does the market react to it? Because the market, again, often reacts irrationally. It may be bad and the market will bounce it, or it might not be so bad and the market will dump it, just because it's a perception, or sometimes it's even just an algo reaction to the headline. So. Welcome, Tanvir. Thank you for also joining us for the live stream. Glad to see you again. Yep, TLT. Yeah, we'll talk about treasuries as well. XLE's energy. Yep. So hopefully you're finding this all helpful. If you do, we hope you'll hit the like button. We hope you'll subscribe to our channel. If you're not already a subscriber, this is the type of thing we go through every Saturday, and then again on Sunday we'll pick our individual stocks based on all this data and our strategies. So let's look in the market screen on Webull. So again, Webull's still offering their 12 free stock deal. This again, you see we use Webull for our due diligence, our market analysis, most of our trading. It's our favorite trading platform. If you're not already using Webull, you can get 12 free stocks, 2 for opening account, each valued up to $300. And then if you deposit any amount, even $1, you can get up to 10 more, up to $3,000. So again, if you're not already using Webull, we would recommend it. And you can find our affiliate link in the description box below. You might as well get your free stocks. You can always cash them out, and if you don't want to use the platform. But you see, we use it significantly. So Friday, you see this big run up, many more advancers, but the percent advance was relatively small, very few significant advancers, small tail of decliners. That inflow, see, normally we've seen the NASDAQ underperform in inflow, and then on Friday it outperformed. So, they were really trying to run the beaten down tech names. And again, we saw where the indices were, and I wouldn't be at all surprised to see that deflate pretty quickly. Again, my opinion. So in Webull on the market screen, if you hit calendar, you can see the near-term earnings calendar. You can watch this during the day, see who's coming up next, who's before market open, after market close. Again, this is a nice near-term earnings calendar to keep an eye on. So we'll look at the best performing industries for the week. Let me grab a drink a sec. Yes, Flip, I like that. That's a classic quote. The market can stay irrational longer than you can stay solvent. Yep. So yeah, be careful. Cash capital preservation, etc. at all times. Risk management, etc. So, but there are ways to make money in any market. That's one of our primary themes. That's what we try to teach on our channel. Is there are always many ways to make money. Kramer and others say there's a bull market somewhere, and so those are the things we're looking for. We're trying to help you find. given that everyone has a different trading style, different tolerances, and a different situation. So we try to give you the information and some ideas to help you make money in any market. That's our objective. That's why we're here. So best performing industries, we saw what happened with solar. So renewable energy was mixed, somewhat positive. Um, Everything retail surprisingly positive. Construction, a lot of things again were green on Friday, um, just because everything was running on Friday. All the indices were up. Utilities even were up. They'd been beaten down over the longer time periods. So all the utilities. So let's look at ETFs. So the indice ones up. They're probably all going to be pointed up pretty much. So Dow up, Q's up, S&P up, mid caps up. So yeah, they're pretty much pointing everything up right now. Ultra short yen, that's interesting. Neither one of the VIX guys is showing as a top performer, so people aren't betting heavily VIX up or down from here. Up on the Russell, up on small cap. So again, we're pointing up on Friday. Aerospace defense, ITA is one, DFEN is another one for aerospace defense. Energy was mixed. You see, like I said, profit taking in there. Communication services, which is the most negative, was actually positive on Friday. Basic materials was mixed, even though that's been one of the stronger ones. Technology was positive. Again, even the SOXL, etc., ran up. Again, even though it's beaten down and the sentiment's generally negative, the guidance is negative, etc. So even healthcare, real estate, yeah. Commodities, lead, carbon, so that's renewable energy related. Carbon, so again, green energy. Let's see what the bonds, if they're showing anything interesting. High yield. British pound was the only one showing positive, so for Forex. So now let's look at the futures. So yeah, we see all these big spikes on Friday for all the indices. Now you see the Dow made a breakout. It broke out above its previous high. It's having the best run. So and it may continue up to its other previous high. So the Dow's having a nice run, and it made lower highs. So it's there's potential for the Dow being out of a bear market, reverting into a bull market. See the big spike on the S&P. It's broken out as well, so it could retest up here. But the NASDAQ has not broken out above its previous high. So again, it's going to hit resistance there. Also, I wouldn't be at all surprised for a retracement in all of these over the short term, and then we'll have to see which direction they head after that. We see this retracement in the VIX. It's just headed down. It's going to keep headed down probably into the interest rate decision, but I expect some significant volatility around that interest rate decision again, because I think the market's expectations are now getting out of line with, in my humble opinion, reality. And that causes the potential for a very negative reaction. So we see oil is just kind of hovering now between 80 and 90. Right now it's around 88. It did run up a little bit, but it's just kind of been bouncing 85, 90, 80 to 90. Heating oil, I've heard there's a diesel scarcity issue. Heating oil spiked up on that. We'll see how that impacts other factors like inflation, etc. Natural gas, you see, and what this is, I believe, is the contract, the futures contract change. They rolled off from October into December, so we got this jump up, and now we're getting this retracement. So it popped up a little bit. Now it's retracing back down. Gold, silver, etc. The dollar got stronger again on Friday to around 110 something. Let me see what DXY is running right this second. It's not showing right now in Thinkorswim. It's because it's the weekend probably. But I know it was 110 or so, ran up above 110, and that pressured all the dollar denominated commodities down that had been running up a bit as the dollar weakened a bit. We see several of the others that are mixed. It's interesting. Coffee's dropping. It's still not, really cheap. So here's the dollar. We saw it was weakening and then popped back up a little bit. Euro broke parity and then dropped back down. Pound recovered a bit, and we see the impact on bond yields and bond prices. So it looks like, the bonds had been bouncing, and then we got that as the yields were declining. And then on Friday, we got a little bit of a pop in yield. So it's a little bit of a decline in the bonds. So Tanvir was talking about TLT, and we're long TMF. So they're recovering. They're still, quite low now. Again, we'll talk about this more detail tomorrow, but when the Fed raises interest rates, whether it be 0.5 or 0.75, the bond yields are going to have to go, well, they don't have to, they should go up based on that interest rate decision, and they should, approach what the expected terminal rate of the Fed interest rates is. So if they go from, if I flip over back to that expectation in investing.com, we could see what the expected rate after this decision is going to be. I think it's like 3.25 or something. So those bond yields are going to have to approach what the actual terminal rate is, which is going to be between 4 and 5, right? So bond yields are going to sit between 4 or 5. As the yields go up, prices are going to go down. So I kind of expect TLT and TMF to take a dip when that Fed interest rate decision comes out. So just, so 3.25 is previous. If they hike by 0.75, it would go to 4. If they do 50, it'll go to 3.75. So again, the bond yields, and then if we get another 75, again, most people are expecting, it may approach 5%. So bond yields may approach 5%. So I hope that helps. So again, FOMC meetings on Wednesday, November 1st and 2nd. The next one's December 13th and 14th. Talked about earnings, looked at futures. So let's talk about zombie stocks. So let me see if there's any questions immediately. Again, here's the links to the videos for zombie companies and zombie ETFs. I'm going to reference that in a second. So here's the zombie companies, and in the description of that video, you'll find a number of references in the description box. So here's several definitions of what a zombie company is, what a zombie stock is, etc. So if you go watch that video, you can read those references. So they're used in that video quite extensively. I just wanted to bring up this little chart. This article has a nice graphic that's used in that video as well for just a quick explanation of what zombie companies are. So I thought this was a good, quick explanation. It's companies with high debt. They can only just service their debt. They're not making enough money to decrease their debt. So they depend on low interest rates. So here's another reason why this is a good subject for this week is we're going to get an interest rate hike. So if these zombie companies are already struggling at the current interest rates and we hike interest rates by 0.5 to 0.75%, they're going to be in more trouble, right? Many of them rely on bailouts. A lot of these zombie companies, they only survived in 208, 209 because they got bailed out by the government, banks, auto companies, airlines, etc. These were zombie companies. A lot of these are still zombie companies. Airlines are zombie companies. They don't really make enough money to pay down their debt. They have huge debt. The only reason they survive is because the government, they're what they call too big to fail or too important to fail. So the government won't allow them to fail, so they keep bailing them out. But again, they don't make money. Um, Arthur, and I'm going to talk in a minute about a number of ways that you can figure out if a particular stock company is a zombie company. So then you can look at Carvana, Open Door. Really, again, I'm going to recommend you do your due diligence and identify if a company you're looking at is a zombie. So again, they can't reduce their principal or their debt. They're just paying interest, and their interest rate's going to go up. So that service is going to absorb more of their cash flow. And too many of them, as you'll read in these articles here in these videos, is these are bad for the economy. They're sucking up resources. They're sucking up human capital, intellectual capital, etc., that could be better utilized in other areas rather than the zombie companies. So you'll see several people will argue, and I would generally agree that it's better if these guys just die off and those resources get deployed more productively in better areas where they can be more productive for the economy. So having these guys around is generally bad. Even the stocks, people are putting their investment dollars in these stocks where they can't grow. They may even be paying a high dividend that's not sustainable, so they're absorbing investment capital that again could be deployed more productively elsewhere. And for you is the future potential of your capital appreciation, your capital growth, your stock appreciation would be better served staying out of these types of zombie companies. And that's why I thought it was important to try to communicate this. And again, I don't want to spend too much time. You can access the references to both of these videos. Again, the zombie ETF one also has a number of references in the description box. What is a zombie ETF? How do you spot a zombie ETF, etc. So I'll let you listen to those videos, explore those references for that information. And if you have further questions, you want more information about those topics, put a comment below this video in our free Discord. Our Discord is free to join. You can find an invitation in the description box below. So again, free to join. We would welcome and encourage you to join our Discord, join in the discussions. We have got a great group of fellow BeachBum traders who help each other out. Again, I thank Walter, etc., for helping out in the chat, answering people's questions as well. So again, great group of traders. We want to grow this group of traders. So tell your friends, tell your fellow traders to come join us in the Discord, join us in the live chats every Saturday and Sunday. And let's help each other out, make money, succeed in our trading careers. So Arthur was just asking about Carvana and Open Door, etc. Essentially, how do you identify a zombie company? And again, those videos and those articles have more information as well. But some additional points that I wanted to make about some things I look at when I'm doing our due diligence and from our experience with various sectors is here's some metrics that I look at to potentially identify as a zombie company, probably more so a zombie company than an ETF or a zombie stock, is if you go in FinBiz or any, or some are in Seeking Alpha, etc., and you'll see I use all those tools in our due diligence. So some of them you might use Finbiz, some you use Seeking Alpha, some you use Chartmill, some you can find in Webull, etc. But in my opinion, they're all useful for staying beware of zombie companies, avoid them, etc. Altman Z is a score that tracks the solvency of or essentially the risk of bankruptcy of a company, a stock, and what you want the Altman Z score to be is positive. The higher it is, the better they are, the less the risk of insolvency, the less risk of bankruptcy. If it's negative or close to zero, they're in deep trouble. You stay away from anybody that's negative or close to zero because they have a very high risk of bankruptcy, and that's what that score measures. Um, I should probably do videos on some of these metrics and the details, the definitions, etc. If and when I can get around to that. But if you're interested, you can find definitions for those in Investopedia, etc. And if you want a video on a particular one, put that in the comments in the Discord, and the ones with the most votes, I'll prioritize. Total debt is obviously important since that's what they have to service, and the higher that number is, a lot of times here I'll give you one example of I talked about the cruise line, so we look at CCL as a good example. So boom, their debt numbers are all red. So when you see that, that's a warning sign, right? Debt to equity's high, long-term debt's high, current ratio's red. Uh, that's a zombie. They got too much debt, and then even negative income. So that one's an easy one. Another one that some of these guys point out, and I'll probably get in trouble for using these, but here's AMC. The current ratio is negative, PE's negative. They lose a bunch of money. One of the authors of one of the articles called out AMC as a zombie company, so that's why I used that, pointed that one out. So don't attack me. Yeah, I agree, Flippa, but again, there are people that feel very strongly about a given company or whatever, and that's fine. But I'm just pointing out that's a good example. CCL and AMC, GameStop, they're good examples of zombie companies. So I just showed their debt to equity, their current ratio, quick ratio. Now, just to show you a way to get definitions, because I don't want to spend the time to define them all right now. But on Finbiz, if you go to the bottom and hit the help and then do a find, Control F find, I could do, let's say, quick ratio, and then you can get a definition of any of those metrics that's shown on the Finbiz profiles. So again, Investopedia, here's how it's calculated. Again, if you want further information about how those are defined, Investopedia is also another great resource for any of these terms, definitions of these terms, how they're calculated, how they're used, what does it mean, etc. Again, long-term debt to equity, I guess that's redundant. Earnings per share, another thing on Finbiz, if you go to the bottom, and you'll see I do this in the due diligence videos. If you see negative earnings per share, and particularly if it's decreasing, getting more negative, that's warning sign they're losing money, and if they're losing more money going forward, they're in trouble, right? How much cash do they have? What's their free cash flow? In other words, how much cash are they generating that they can use above just paying their debt service? Cash burn rate, how much cash, if I know they've got X amount of cash, but let's say they got 100 million, but they're burning it at a rate of, let's say, 40 million per quarter. Another thing that I've calculated, particularly for biotechs, and I'll talk about that more again in a second, but as I calculate the quarter's cash flow positive, so I figure out if I had 100 million, they're burning 40. In 3 quarters, they're going to need more money. So they're either going to have to do an offering, or they're going to have to get more debt or something. And a lot of times that's a risk that they're going to dump an offering on you. A great example that just happened was Bed Bath and Beyond, or as I put it, Bed Bath and Bankrupt you all, or other people call it Blood Bath and Beyond, or Beyond Bloodbath. And again, don't attack me, but that's like I said, I've been calling Bed Bath and Bankrupt y'all for a while. And sure enough, they just dumped a big offering because they're going bankrupt. They got to try to get more cash to stay out of bankruptcy. So another one that I use and calculate, and you'll have, you can look this one up. The definition is it's called the Graham number, and it's from Ben Graham, who's a value investor, the mentor for Warren Buffett, etc. And it's another measure of the value and solvency of a company. So it's another calculation. And the reason I bring several of these up is back when we used to trade biotechs, and we started out trading biotechs pretty heavily. And made good money on biotechs. And these are some of the things I learned as to risk factors to avoid getting caught in a company that was going bankrupt, or they're going to have to dump an offering on you, or they're going to do a reverse split, essentially to resell those same shares, which is why I highlight that as another, something to watch out for and be aware of is these biotechs or these zombie companies. One of the ways that they can get more money is they'll do a reverse split, and they'll sell it as, oh, we need to get over $5 or $10 so the mutual funds, the money managers can invest in it, etc. And then what they do is, because they've reduced the float by, let's say, a factor of 10, is they turn around and they resell the 90% shares that they just got back due to the split, so they don't have to do another filing, etc. They can just resell those shares because it's already within their allotted shares that they're authorized for. So again, it's something to watch out for if you get into one of these companies like Bed Bath & Beyond or any other company that's a zombie company losing a lot of money. One way they can get more money is do a reverse split, get those shares back out of the float, and then turn around and reoffer them. So often after one of these reverse splits, you'll see it followed up pretty quickly by another offering. So that's the other thing, is to watch out for is shelf offerings. And you have to look at the SEC filings to see these various filings for. And I'll have to dig. And I did a video on how to find a non-compliant and offerings. So it's quite a while ago. I'll have to dig that back up and look at them. The one I look for is effect, because after they request and a new offering, increasing their shares outstanding, they can't actually do the offering until the SEC puts that offering in effect. So once they get notice that it's now in effect, then they can drop that offering at any time. Shelf offering is one that they've had approved. It's in effect, and they haven't publicly announced it. They haven't set a price, etc. yet, but it's sitting there. And a lot of times they'll pump the stock, drop a fluff press release, it'll pump the stock up, or if the Twitter guys pump it, price shoots up, that's when they drop the offering. So again, things to be careful of, again, particularly on these zombie stocks, because they can't survive without some other external support. Being bailed out by somebody, either the government or shareholders, or somebody has to bail them out for them to continue to survive. So I'll wrap up pretty quick. Let me see if there's any questions. Again, if I missed your question, I apologize. Again, I had a lot to cover today. You can always put it in a comment below. I'll try to address it as I'm able. Join us again in the Discord. You can ask it in the Discord at BeachBum Trading in the Discord. And I'll be notified of that and see if I can answer your question there as well. Also, we have a Facebook group and our social media, and you can find links to all our social media. Also, a link to the invite to our Discord server, our Facebook group, etc. on our homepage, which is beachbumtrading.com, bum without the U. Go to the links section, you'll find all our social media. Also, links to all the trading platforms, all the tools that we're using and showing, as well as others, all these resources. Reference links, investing.com, etc., Investopedia, etc., the options calendar, OPEC meetings, all kinds of stuff, market holidays. So, yeah, a lot of resources there under the links section on our homepage. So, again, you can hit us up on any of our social media sites, and I'll try to answer your further questions. So I left the links in there about making money from the Fed interest rate decision back from the last Fed decision. So it's got, strategies on how to make money when interest rates rise. One of them's still unlisted, but you can access them via these links. And again, we expect interest rates to rise. So this week, it's the only question is it going to be 50 or 75? Again, in my humble opinion, I think it's going to be 75. But if I'm wrong, if they only go 50, I think the markets will rally pretty strongly because that's what they want to hear. If it's 75, as is pretty much expected, the reaction could be pretty negative because it's not what the market wants to hear. It's really what they should expect, in my humble opinion, again. But I think they'll react negatively. So in those videos, we talk about, how to make money either way. So thank you again, everyone, for joining us. I hope it was helpful. Again, if you have further questions, put a comment below this video. And if you have individual stocks that you want us to look at prior to tomorrow's part 2 of our weekly trading game plan, again, you can put them in the comments, in our Discord, in our Facebook group, etc. So, and again, please come back 10 a.m. Eastern Time tomorrow for part 2. Same bat time, same bat channel. And we'll see how we can apply all this information to the stocks we want to put on our watch list and watch for next week, Halloween week, October 31st through 11/4. So hope this all helps. Good luck. Have a great rest of your Saturday, and I hope to see you all tomorrow. Same bat time, same bat channel. Bye.